All right.
All right, this is Mark Chaikin, and I'd like to welcome everybody from the Chaikin Analytics community to today's webinar, The Art of Trading and How to Simplify Your Trading and Grow Bigger Profits. When Mark Dannenberg first presented to the Chaikin audience on March 5th, I hadn't met him, but I was impressed with his methodologies. And 8 days later, I had the pleasure of meeting Mark at a trading conference in Las Vegas, and I understood why the Chaikin community responded so positively to his presentation. Mark was a businessman who has now segued to a teacher and an options trader, as only someone with a California lifestyle can do. And it became apparent in talking to him at this trader conference that his real passion is helping his clients, his subscribers, become more profitable traders, and that at every turn, Mark has the best interests of his subscribers at heart, so that when we talked about partnering, it wasn't about what's in it for me, it's what's in it for my client base. So it gives me great pleasure to introduce someone I now consider a friend, Mark Dannenberg, who's going to talk about The Art of Trading, which is a book that he's written, and the whole notion of simplification is one that's so consistent with the Chaikin methodology that I think everybody will not only enjoy the presentation, but learn how to integrate what Mark's talking about into what we do here at Chaikin. So with that, it's my great pleasure to introduce Mark Dannenberg.
Mark, thank you very much. That's a very nice introduction, and I appreciate having an opportunity to talk to the people from the Chaikin community today. So the art of trading and how to simplify your trading and grow bigger profits is what I want to spend a little bit of time talking about today. It's near and dear to my heart because I've been a trader for a very long time. And there are so many different levels of complexity in trading nowadays that can interfere with a person's confidence and their success. And I like to start with a very simple approach. And of course, there are a lot of people who will want to build on that and create greater levels of complexity, but you've got to build a strong foundation first. So I'm going to spend a few minutes today talking with you about how to achieve that. My background is that I was a senior executive for a Fortune 500 company for 26 years. I ran multiple divisions for this company. I had as many as 2,500 people that I was responsible for around the world. And I loved what I did, but I had a strong desire for what I described as lifestyle freedom. I traveled extensively in my role. I traveled about 40 weeks out of every 52 weeks during the year, and I wasn't begrudging about that. I enjoyed what I did, but I wanted the lifestyle freedom where I could pick and choose where I wanted to live, pick and choose where I wanted to travel, pick and choose how long I wanted to stay anywhere. And I started to trade, and it became apparent to me that I could achieve that goal possibly through trading. I spent 20 years trading as a hobby. As I started to get very serious about it while I was still working, I realized that it could possibly be a replacement for the career I had. Maybe at some point in the future, I wouldn't enjoy my career as much as I was at that time, but I wanted to have some sort of a backup. And I've spent the last 10 years teaching other traders how to achieve that same level of simplicity and same level of success in trading. I founded Options Moneymaker in 2009. Now I've been teaching longer than that, but I formally founded Options Moneymaker in 2009 and started attracting other traders outside of my circle of social contacts and business contacts, and really teaching traders the art of trading. I host a live trading room every day. So all of the trading education that I provide is based on real-time trades. It's not based on something that I might have written down or experienced a few years ago. It's all based on real-time experiences on a daily basis. I'm actively trading every day, and throughout the live trading room, I'm actively coaching. And ultimately, I did achieve the goal that I had of lifestyle freedom. I get to live in Northern California and enjoy living at the beach and having the flexibility to do what I do from anywhere. So let's figure out what I can do to help each of you achieve whatever goal you might have regarding trading. Who's going to benefit from today's presentation most? Beginning traders who might be looking for a way to get started. Maybe you've just been introduced to options and you're not exactly sure how to get started. You understand the basics, but you don't know what the first step is to actually go out and implement what you learned. I'm going to give you something today that could be a strategy to help you get on the right path. Also, experienced traders who may be seeking a greater level of success. Perhaps you trade, but you're not satisfied with your results. Perhaps you're inconsistent. You have big wins, you have bigger losses. We all have wins, we all have losses, but the objective is to keep more of our profits than our losses take back. So if you'd like to learn how to trade and earn more and perhaps even simplify your trading and not make it a burden to yourself, then I think today's presentation might help you. Anyone who's committed to learning a lifelong skill, knowledge can never be taken away from you. So if you have a job, if you have a business, those things can be taken away for a variety of reasons, unexpectedly. But as long as you have the knowledge and enough capital to get started with, trading the markets is something that you can always do for the rest of your life. And you can pass it on to other people in your family. And then, of course, traders who might be just seeking a simpler way to trade and to earn. We really focus on minimizing fear and anxiety with trading, which is so prevalent amongst traders, and taking that lack of fear and anxiety and learn how to grow a bigger account. Now, I am going to take questions at the end of today's presentation. If you have a question, feel free to put it in there. What I find is that frequently the questions that are asked early in the presentation are actually answered later. So feel free to put a question out there and I will take a look at them later on. Or you can wait until the end of the presentation. All right, I'm going to be talking about credit spreads today. Now, credit spreads are a very simple directional strategy. It's one of the simplest options trading strategies that traders can use. So if you're looking for a way to start your trading or reignite your trading, credit spreads are a great directional strategy to employ. They're simple, but a lot of traders fail trading credit spreads. They don't know how to properly select strikes. It's kind of a haphazard approach, or it's so fixed and rules-based that it's not flexible to whatever's going on in the market. They don't build sufficient time into their positions, and they will oftentimes choose the right direction and the right strikes, but they just didn't build enough time into the position to allow the market to cycle favorably for them. Oftentimes, traders will fail trading credit spreads because they have a naive assessment of risk, and they have too much risk in play. They don't really understand how to size and assess the risk. And frankly, one of the best measurements of risk is if you're losing sleep at night and you're worried about your positions, you personally, for your portfolio, you have too much risk on. Trading should not be something that keeps you awake worrying about your trades. And one of the reasons traders fail is that they have no adjustment strategy. They don't really know how to get out of the position properly if it hasn't worked out the way they originally intended it to be. So knowledge of how to properly manage a position is going to significantly improve your success overall. I'm going to give you some examples of positions tonight. And one of the last examples I'm going to give you is how to properly manage a position and guide that position to an ultimate profit. So the topics for today are how to trade credit spreads with minimal true risk, and I'm going to help you understand what that is. I'm going to talk about the forgiveness factor, and I'm going to talk about the time factor that we build into our trades. We're going to talk about selecting strikes and expirations, and we're going to talk about how and when to adjust a trade. I'm going to give you some rules that will help you define when it's best to adjust a trade. In fact, I'm going to give you 3 very specific questions that if you use these 3 questions every day in evaluating your position, you're going to know pretty much when you need to make an adjustment to that trade, and I'm going to show you the types of adjustments that you would make. And then I want to show you how to properly compound your account for bigger account growth. So let's first of all talk about what is the forgiveness factor. The forgiveness factor is essentially when the price of a position moves against your position. The price of an index or stock that you're trading at moves against your position. You thought that there was a particular directional bias, you thought that the market was going up or you thought it was going down, and you placed a trade according to that view. And then it turned out that you were wrong. Well, the forgiveness factor is allowing the index or stock to move against your position, and you can still make a profit or break even. It's also about placing natural barriers between the current price of the stock or index and the risk strike. What point on the of risk do you have, and where is the current price of the stock or index trading? And we want to have some natural barriers between those two. It's also about just plain being wrong on direction or timing and still potentially winning on your trade. Now, I like to have a forgiveness factor built into my trade, and I'm going to explain that right now as I describe this trade to you. This is an example of a credit spread trade. This is not, one trade that we had that was designed this way. It's the type of trading that we do almost every single day in our live trading room. So NDX, which is the NASDAQ 100 index, was the equity that we were trading. We trade indexes, and I'm going to talk more about the whys of that, but we basically confine 98% of our trading to NDX, NASDAQ 100, SPX, which is the S&P 500, and RUT, which is the Russell 2000. Don't confuse those 3 with their corresponding ETFs. These are the indexes directly. So we placed this trade during May week 1. So it was the first expiration week of May, and NDX was trading at 45.30. Our view of the chart was that there was a declining bias, that the index was prone to move lower, and we wanted to take advantage of that. And we decided to open a credit spread to take advantage of that trade. What we did was we sold to open a May week 3 NDX 45.95 call and simultaneously bought to open a May week 3 NDX 4600 call. Now, we typically place our expirations 2 to 4 weeks out from the current date. So we are trading in the middle of May week 1, and we went out to May week 3 in order to place our trade. This is a credit spread, and it's a credit spread, and it's called a credit spread because the leg that we are selling to open is closer to the current price of the index than the leg that we're buying to open. And that means that when we sell to open the 45.95, we're going to receive more credit than the debit we have to pay to buy the 4600 call. When we net those two together, the credit from the 45.95 and the debit from the 4600, we receive a credit of $1.60 on this trade. Now, one thing about credit spreads and assessing risk is the risk on a credit spread is always restricted to the difference between the strikes. The maximum risk and exposure we could have to loss on this trade is $5. That's the difference between the strikes. So our gross risk is $5, 5 points. Now, if you're trading one contract, each contract represents 100 shares, so that would be $500 of risk. If you're trading 10 contracts, that would represent 1,000 shares. That would be $5,000 of risk. But because we took a credit when we opened this spread, the credit was $1.60, we actually mitigate a portion of that $5 of gross risk, and we incur actual net risk of $3.40. So we open this trade knowing that the maximum we can lose on this trade is $3.40 per share. This trade is set up to benefit from a move down, but it also has a forgiveness factor built in case NDX moves up against our position. And that forgiveness factor is 65 points. You see, NDX was trading at 45.30 when we opened the position. We placed our risk point, our risk strike, which is 45.95. I call that the risk strike because we want NDX to remain below 45.95. And if in fact it moves above 45.95, we start to incur potential losses. So between 45.30 and our risk point of 45.95, NDX can move 65 points against my position, and I will still have a profitable position. Now, the factors considered in choosing this trade, and I'm going to show you a chart that you can visually see what I'm talking about, but we don't just arbitrarily choose a strike that is out of the money. We don't arbitrarily choose probability. We don't arbitrarily choose anything. We have a variety of factors that we consider, but once you understand what we are looking at, you're going to realize, I believe, how simple it is. And my whole mantra about this type of trading is keeping it as simple as possible. So number one, the factors we considered in choosing this trade, number one was NDX had achieved the highest price it has achieved in 15 years, and that highest price was 45.6233. We placed our risk point 33 points higher than the highest high that NDX had achieved since March of 2000. With the exception of the month of March of 2000, it's actually the highest all-time high. So that doesn't guarantee us anything. It doesn't guarantee that the index isn't going to move higher, but placing it 33 points outside the highest high that the index has achieved in 15 years says there's some natural resistance out at that price level. We also use Bollinger Bands. It's the primary tool we use for technical indications. And we use 2 and 3 standard deviation Bollinger Bands. Now the 3 standard deviation Bollinger Band was set at 45.80. And we placed our risk another 15 points outside of the Bollinger Band, the 3 standard deviation Bollinger Band. Again, that's a natural level of resistance that the index is going to potentially encounter if it moves against our position. And then we had 2 levels of resistance in the way we identify channels, support and resistance. And I'm going to show you the chart here in just a minute. And we had 3 weeks to expiration, which allows us plenty of time to modify and adjust this trade if we are forced to. So here's a simple chart. Now, simplicity for me is key, and we try to keep things just as simple as possible. The Bollinger Bands are one of our primary tools, especially when we're helping traders just start out with their options trading. What we find with the Bollinger Bands, very simply, is that the price of the indexes just cycles back and forth between the upper and lower Bollinger Bands. And there are times when the price will move outside of the Bollinger Bands, and the majority of the time we find that in a very short period of time, the price is going to snap back inside the Bollinger Band envelope. So when you see the price exceed below the Bollinger Band or above the Bollinger Band, there's a high degree of probability that it's going to snap back inside the Bollinger Band. And we use that as one of our tools. So here, our risk is at 45.95. That's where that horizontal line is. That's our risk point. The high that hit on 427, which was a 15-year high, we are well above that high, and we have placed our risk point well above the current pricing of the 2 and 3 standard deviation Bollinger Bands. The 2 standard is the inner Bollinger Band, and the outer Bollinger Band is the 3 standard deviation. And then you can see here that we had a line of resistance where we had identified a declining line of resistance on this pattern. And so we would need to move above that resistance, above both the 2 and 3 standard deviation Bollinger Bands, above another long-term rising line of resistance, as well as form a new all-time high in order to encroach on our risk point. Now, all of that could happen. We're not saying that this won't happen. We're saying that we're stacking the deck in our favor, and that the likelihood of that happening becomes less and less the more natural barriers we put between the current price and our risk point. This trade uses time and a forgiveness factor. We built 3 weeks into the trade. If the index does move against us, then we've got time to manage and adjust the trade if necessary. We build a 65-point forgiveness factor into the trade. This is very simple to identify. When you start to recognize Bollinger Band patterns and you recognize support and resistance, if that's where you start your basic charting, it is very simple for you to identify, and it's very simple to set up the trade on a credit spread. Once the trade is open, we automate the close as much as possible. We don't want you to have to sit in front of your computer all day looking for an opportunity to close the trade. People have other lives, people have jobs, businesses to run. They want to go out on the golf course, they want to go surfing, they want to do whatever they won't like to do. Set a good till canceled order to close the trade for a profit. Now, a 10% profit is a good guideline, but very simply, whatever the credit on the trade is, we typically set our good till canceled order to close for 50% of the credit. So if we opened the trade for a credit of $1.60, we're going to set a good till canceled order to close for a limit debit of 80 cents, and that would give us an 80-cent profit. We're going to take in $1.60 when we open, we're going to give back 80 cents when we close, and we're going to keep the 80 cents difference as a profit. We don't hold our trades. This is another mistake that a lot of credit spread traders make. We don't hold our trades to expiration. We are more interested in getting out quickly, leaving some money on the table, and getting back into a new trade, and we're going to recycle our capital frequently and compound our profits. This is the type of very simple trading you can do, allocating 15 to 30 minutes a day. You spend 15 to 30 minutes a day reviewing your charts for possible new trades and also reviewing your existing positions. Now, I know this can be done in 15 to 30 minutes a day because one of the services that we offer is I do a complete chart and position analysis that I record every day in 15 to 30 minutes, and we send out to our subscribers. So as people are just learning, they aren't left on their own. I'm actually doing the work for them every day so that during the course of their learning, they can start to feel more confident with what they are recognizing by listening to my analysis. Now, the cool thing about the credit spread is it can be also used to create a non-directional trade. A non-directional trade then is not requiring you to determine which direction the index is moving. When we put together a put credit spread as well as a call credit spread, that is what we call an Iron Condor. Now, I didn't create these strategies. What I've done over the years is I've learned how to interpret these strategies and use them most effectively. There are so many different ways you can trade credit spreads and trade Iron Condors, but there are a few ways that you can be consistently successful with it, and that's what we teach. Iron Condor, you're going to open both a call and a put credit spread. Eliminates the need to assess which direction the index or stock you're trading is moving. Now you have a potential profit regardless of price movement. One side of your spread, one side of your Iron Condor is going to win on a move, and the other side is going to benefit from the forgiveness factor. So when you have both a put and a call spread in play, and you have built in a forgiveness factor, the index is going to move against one of those sides. It's just going to happen because the index is going to move. But if you've built a forgiveness factor in, that side it moves against could still be profitable, and the side that it moves favorably for will most definitely be profitable. You can set up an Iron Condor just simply using Bollinger Bands as a guide for choosing your strikes. If you place your strikes outside the 2 and 3 standard deviation Bollinger Bands, or if you place them outside support and resistance as you become more proficient at identifying those, then you can very simply place your Iron Condor and wait for the index to move and cycle up and down. Now the indexes that we trade, which I mentioned before, let me just back up here, are NDX, NASDAQ 100, SPX, the S&P 500, and RUT, which is the Russell 2000. All three of these are excellent for Iron Condors because they have very consistent cycle patterns. And when you start to recognize them, you may never ever want to trade another equity. We don't trade very many stocks. We trade these indexes. This also is a way to simplify your trading. You don't have to constantly be scouring the universe for optionable stocks. Indexes are a great strategy for you. But there's one other very important reason to trade indexes that we focus on, and that is the style of expiration. Most stocks and ETFs are American style expiration, which means that if your risk point is in the money, you can be assigned at any time leading up to expiration. That one factor is all by itself it results in anxiety for a lot of traders. It makes traders feel very anxious. They're fearful of being exercised or assigned. But NDX, SPX, and RUT are what are called European style expirations. And so if your risk point is in the money on one of these indexes, you will not be assigned or exercised until expiration. That one factor simplifies your trading because you don't have to be worried about being assigned or exercised. We will sometimes carry a position that is in the money for a few days, but we don't worry about being exercised or assigned. It takes all of that off the table. That one fine-tuning thing is what we call blind spots on American style expiration. There are so many blind spots in trading that people don't even understand. I'm very familiar with blind spots, and I use that analogy because I'm an avid motorcyclist and I've been riding for 40 years, and I am very aware that there are blind spots when I'm out on the road. Cars, trucks don't see me. I have to be alert to where those blind spots are and stay out of them. Trading is the same way. If without knowing it, without being aware and alert, you put yourself in a blind spot, you can very likely end up with an outcome that you don't like. That's true for motorcycling as well as riding. You can open both sides of an Iron Condor at the same time, or you can leg into each side as the index cycles. Legging in means I might open the put spread, and then a day or two later, or even within that same day, I might separately open the call spread. It just depends on how the index is cycling. But Iron Condors are an excellent way to grab profits regardless of which direction the index is moving. So let me walk you through an example of an Iron Condor that we did on RUT that started out as just a call spread and then ended up morphing into an Iron Condor. On April 8th, we sold to open a 1280, 1285 April week 4 call spread, and we took in a credit of $1.40. Now we had 2.5 weeks to expiration. The index at the time was trading at 1260, and so we had 20 points of forgiveness. So we felt that there was a declining bias indicated on the chart, and I'm going to show you the chart that represents this trade in just a moment. And we went 20 points out of the money, so we have a 20-point forgiveness factor, and we went 2.5 weeks out in time so that we aren't running right up against expiration and running the risk of losing control of the position. The next day, on the 9th of April, we closed that call spread and took a profit. We had a credit of $1.40. We closed it the next day for 80 cents, and we kept 60 cents as a profit. Now on a 5-point spread, 5 points of gross risk, 60 cents of profit is a 12% return. Also on the 9th, because the index had moved down to 1250, it had moved down 10 points, we closed that call spread, and then we immediately redeployed that capital and opened a 1230, 1225 April week 4 put spread. So we saw the index move lower, 10 points lower. Our view on the chart, based on what we saw, was that it looked like the index from here might move back higher. And we still had 2.5 weeks to expiration, and we now have a 20-point forgiveness factor on the put spread. We took $1.12 of credit on that trade. Later on that same day, on the 9th, the index in fact did move higher, and we reopened the call spread that we had just closed earlier that day. We reopened the 1280, 1285 April week 4 call spread, and we took a credit of $1.30. Now look at what the opportunity is here. The cycle of RUT allowed us to open the call spread for $1.40, close it for 80 cents the next day, and on that same day reopen it for $1.30. At this point in time, we have both the put spread and the call spread in play, a $2.42 total credit, $2.42 on risk of only 5 points. Now I want to emphasize this here. When you have an Iron Condor in place, you have 5 points of spread risk on the put, and technically you have 5 points of spread risk on the call, but you only actually have 5 points of spread risk on the entire Iron Condor, because it's impossible for you to have a loss on both the call spread and the put spread simultaneously. And your broker only requires you, most brokers only require you to set aside the 5 points on one side or the other. So what that means is I can take in additional credit by opening the call spread, but not increase my 5 points of gross risk. I still only have 5 points of gross risk, but now I have $2.42 of credit against that 5 points of risk. On the 10th, which is now 2 days from originating this position, next day after we created our Iron Condor, we were able to buy to close the puts. The index had cycled back higher. We closed the puts. We gave back 60 cents and kept 52 cents as a profit. And then a week later, on the 17th of April, we bought to close the 1280, 1285 calls. We paid back 40 cents, so we kept that. We kept the 90 cents as a profit. So the summary of this trade is that leveraging the cycles by legging into an Iron Condor gives us an opportunity for greater profits. This trade lasted 7 trading days. It was 9 calendar days, and we ended up taking in a profit of $1,010. Now that's based on trading 5 contracts on each call spread and put spread that we were trading. 5 contracts represents 500 shares. $2.02 of profit per share equals 1,010 of profit. Now when I take that $2.02 of profit and I divide it by my gross risk of $5. The maximum amount I could lose on this trade, not taking into account the credits, the maximum amount I could have lost on this trade is $5. So by taking in a $2.02 profit on this trade, we end up with a 40.5% return on that 5 points of spread risk. Open and close on the cycles. Get very comfortable with the cycles of movement on RUT, NDX, and SPX, and it allows you to recycle your capital over and over again for bigger returns on the same capital. So here's a chart, simple snapshot of the chart that shows how we placed this trade. Here we started by selling to open the call spread, right here. We were trading right near the upper Bollinger Bands. The next day, the price dipped below the 2 standard deviation Bollinger Band. Now we look at that and interpret that as a pattern that says there's a high likelihood that you're going to see the pattern snap back up off of that Bollinger Band. In fact, we refer to this as a Bollinger Band snap. So we closed the call spread and took our profit and opened the put spread. We did get a snap back up, and we sold to open the call spread again. Now, I think in hindsight, we were a little premature in reopening this call spread, but that's okay. It worked out for us. The call spread, the index continued to move higher, and it pretty much flattened out here for a couple of days. And in here, we were able to take a profit on the put spread. And then we were only left with a call spread, and you can see how the index moved back and forth between the Bollinger Bands until we saw a more pronounced move lower, and we were able to close the call spread. But the simple takeaway of this is just look at your Bollinger Bands, the 2 and 3 standard deviation Bollinger Bands, and look at how the indexes cycle back and forth between those Bollinger Bands, offering you opportunities to get into positions and get out of positions multiple times over a short number of days. Now, managing a position and learning how to do so is important. Sometimes even when you build a forgiveness factor in, a position requires an adjustment. There are 3 very simple ways to adjust a credit spread. And if all you ever do is follow these adjustments, and you just follow them because they work, you can be very, very successful with your credit spreads. The first one is roll out. And that means that you move the expiration out in time to add more time to the trade. Sometimes you just know that the trade is still a good trade, but you're running out of time. The thing about options is they have a limited lifespan to them. So you need to have enough time for the trade to be able to work out profitably. So a rollout is when you roll the position out by moving the expiration further out in time. And I'm going to show you an example of that in just a moment. A reposition is when the price of the index is moved against your position, and now you want to move the strikes back out of the money. So you can adjust the strikes, reposition them higher or lower, and you can set the position now so that it's out of the money and has a greater likelihood of winning. And then the third adjustment is you do both. You may roll out to buy more time, and you may simultaneously reposition in order to put your position out of the money. There is one other one that we use periodically, and it is when you do a rollout or a reposition, and the cost of that rollout or reposition is not working out favorably for us, and so we may widen the spread of the spread at the same time. So if we started with a 5-point spread, we may widen it to a 10-point spread. It requires a bit more capital, but we're very conservative on our capital placement initially, and we always keep capital in reserve to manage when we need to. Generally, though, if you're just doing one of these 3, there's a very small capital requirement in order to manage. It's not a big deal, and these are very simple to execute. So the management of a position and adjustment of a position is not complicated. Once you learn how to do it, and you've done a couple of them, it'll become second nature to you. But it's knowing when to manage and adjust that really interferes with a lot of traders and gets in the way. They're just confused about it. So I'm going to tell you that this is the process you should do on a daily basis whenever you hold a position. If you review your position each day, whatever positions you have, and you ask yourself the following 3 questions, you're going to have a very clear understanding of when is the right time to manage or adjust a trade. Question number 1, is there a profit in the trade? If the answer is no, move on to question 2. If the answer is yes, then consider whether or not it is a profit that you would want to take. Generally, I consider a 10% or greater profit worth chasing, worth pursuing, and might want to go ahead and take that trade off. I will always review the chart for indications of any shift in the directional bias. So that's a little gray area for you to decide if you want to take the position off and take a profit, but that's a good thing, okay? You might take a slightly less profit than someone else, but a profit is a profit, and any profit is better than any loss. But if you have no profit, there's no decision to make. The second question you want to ask then is the risk strike in the money. Now, you built your position with a forgiveness factor. If the index is now moved against your position, your risk strike might be in the money. But if the answer to that is no, then there's nothing else to consider. If you don't have a profit in the position and your risk strike is not in the money, then you move on to question 3. If your risk strike is actually in the money, then that is the first clue that this position may require a reposition or a rollout. And then the last question, the third question, is expiration less than 1 week away? If the answer is no, you're done. If the answer is no profit, I'm not in the money, and expiration is not less than 1 week away, there's nothing else you need to do on this position for that particular day. I don't even care what happens after you review position later on that day. You've set aside 15 to 30 minutes to allocate to your trading. There's nothing else you need to do except wait until the next day and do the same review again the following day. If expiration is less than a week away, that again may be an indication that the position requires a rollout, especially if you don't have a profit. If the answer to question 2 and 3 is yes, your risk point is in the money, and yes, you're less than 1 week away, that is almost a certainty that now is the time to take action. So by learning these 3 questions, getting comfortable with these 3 questions and doing them consistently, asking them consistently every day during your position review, you're going to very clearly know, instead of taking an emotional approach to your positions, you're going to take an academic approach to your positions. You're going to know when it's time to make an adjustment. So let me give you an example of a trade here that we did an adjustment on. NDX was trading at 43.80, and we opened the following Iron Condor. On March 30th, we opened an April week 3. Okay, we have 2.5 weeks to expiration. April week 3, 44, 44, 45, 44.50 call spread, and a 4,300, 42.95 put spread. And here are the credits that we took on those. There's a 65-point forgiveness factor on the calls and an 80-point forgiveness factor on the puts from where we're currently trading. This is a well-placed Iron Condor, and we opened both legs at the same time. On the 2nd of April, we closed the calls. We gave back 65 cents of the $1.66 we took in. That was a nice profit. On the 6th of April, 4 days later, we reopened a call spread because at that point, all we had was the put spread left, so we could add another call spread back in, and we took a credit of $1.50. On the 9th of April, we bought to close the put spread, The index had moved higher, and we gave back 50 cents. On the 10th of April, and I'm going to show you a chart again to help you visually see when we took action on each of these. On the 10th of April, the index had moved above 4,400. Now, 4,400, 4405 was our new call spread. So at that point, our risk point, our 4,400 was our risk point, and it was in the money. So we are doing our 3-question evaluation every day, and we determined our 4,400 call spread is in the money. It's time for us to make an adjustment. We were also starting to run out of time because we held an April week 3 expiration. So what we did was we opted to do a rollout. We rolled out and we added more time to the position. We rolled out to May week 3. That rollout is essentially closing the April week 3 and opening the May week 3. We bought to close the April week 3 for $3.40, and we sold to open the May week 3 for $3.20. That management move cost us 20 cents. It wasn't expensive, and what it did was it allowed us to hold for a down cycle, which we felt strongly was coming based on the chart, and we did not run up against April week 3 expiration. We bought ourselves an entire month. It's not our intention to hold for another month, but we want to have a month available to us so that we can continue to control the position. On the 17th of April, where we would have run right up against April week 3 expiration, we were offered an opportunity to close the May week 3 position. We paid back $2.20 to close that. This rollout allowed us to hold and wait for the down cycle. We always know there's a down cycle coming. We always know there's an up cycle coming. That's what happens with the indexes. They cycle up and they cycle down. All you have to do is look at an intraday chart, look at a 10-day, 10-minute chart, and you'll see exactly what I'm talking about. Leveraging the cycles and managing a trade on NDX resulted in an overall profit. Now, it wasn't as big of a profit as we thought we might end up with when we first started this trade, but it did end up resulting in a profit. We were in the trade for 14 trading days, 18 calendar days. We ended up with a $468 profit. After we netted together all of our profits and losses on each leg, on 6 contracts, 78 cents of profit equaled $468 of profit. That was a 15.5% return on the 5 points of spread risk. So despite the fact that we had to manage this trade, despite the fact that it cost us money in the course of management, when we take all of that into account, we ended up with a 15.5% return. You can open and close on the cycles. I would much rather help you learn how to manage positions properly, very simply, rather than be filled with worry and anxiety about what's happening. You see, worry and anxiety is a product of lack of knowledge. You just don't have the knowledge and confidence in what you're doing. If you have knowledge and confidence in what you're doing, you won't worry about your positions. You're just going to use a very academic approach to managing your positions. Adjustments buys a lot of peace of mind. So here's the chart. This shows where we opened the Iron Condor. The 44.45 was our call risk point, and the 4300 was our put risk point. You can see that that strike was well outside resistance, as well as both the 2 and 3 standard deviation Bollinger Bands. Now the 4300 was above the Bollinger Bands, but it was below support of the channel, this cycle that we were tracking. It ended up, the price of the index ended up moving below our 4300 risk point, but we didn't take any action. The put spread was actually in the money, but the price had moved below the Bollinger Band, so that was a day we chose to just let it ride for another day or two. And we were right. It snapped back higher, allowing our risk point on the put to be out of the money. We opened a new call spread here at 4,400, and then the index continued to move higher, actually moving against our 4,400. When the index moved up to here, it was time for us to roll out. Our 4,400 was in the money. But we were watching this trade right along the upper Bollinger Band, which still gave us a high degree of confidence that there would be some sort of a pullback in the price, because we know through experience that the price roams and cycles back and forth between the upper and lower Bollinger Bands. So we just bought ourselves more time. We rolled out to May week 3, and then we were offered an opportunity here, an opportunity to exit. And we decided to exit there rather than holding out for more profit, because we had a Bollinger Band snap setup, meaning we saw this pattern and we thought pretty confidently that it would snap back higher. It ended up that we were right, but we took action here because we didn't want to be in this declining bias trade if the index cycled back higher against us. So it really boils down to all being about the charts and trading the cycles of the indexes. So if you can leverage the cycles based on the Bollinger Bands, it's a great approach for newer traders. It's relatively simple to learn, and we are all about keeping it as simple as possible. Build a forgiveness factor into each trade. It helps you be wrong, but potentially profitable anyway. Give your position time in order to avoid the roller coaster fear and anxiety of running right up against expiration. I've watched so many credit spread traders trade the near-term expirations, and they're euphoric because it looks like they're going to have a full profit on their trade, only for all of that profit to be wiped out on the last day of expiration because there was an unexpected move in the underlying stock or index. You just do not need to trade that way. And it complicates things and makes you start to think that you don't really know what you're doing. This is really how simple trading can be. So I just want to share with you a program that we have that would help you learn how to do this. And if it's something that interests you, great. I'm going to take questions here in just a minute. We have what's called a profit builder program. We'd like to help as many traders as we can learn to simplify and enjoy their trading while growing their account to a pretty big account. This is a chance to participate in a program that we started based on our live trading room trades. We do these trades in our live trading room. This is not an offer to join our live trading room, although if you are a more experienced trader and that's something that interests you, you can certainly let me know, email me. I'll give you my email address in just a moment. But what we do in our live trading room is we identify good trades, and then we send out an alert to our subscribers telling them this is a trade that we opened and this is part of our Profit Builder program. Initially, what we do is we suggest that traders allocate $5,000 of trading capital. This doesn't mean have a $5,000 trading account. It means that maybe you have an $8,000, $10,000, $12,000, $20,000 account, but initially you're going to set aside $5,000 of that for trades. That can be anywhere from 2 to 4 trades that we allocate to that $5,000, and the balance of the capital is reserved for adjustments if and when we need to make those adjustments. We're going to compound profits each week into new positions, and we continue that compounding for 1 quarter, for 13 weeks, and then we reset at the beginning of the next quarter. $5,000 of starting capital, if we made, say, $600 in the first week, in the second week we're going to trade $5,600. If we made $300 in the second week, in the third week we're going to trade $5,900. So it's that quarterly compounding which accelerates our profits, and then at the beginning of the next quarter we reset to either 5,000 or 5,000 plus a portion of the profits from the prior quarter. But the rest of the profits that we earn during the quarter are set aside with no risk. We trade these trades in our live trading room across 4 different accounts, and then we alert them and track them in a specific account for our subscribers. Our current run rate across those 4 accounts is averaging 12% per week. That's 12% per week of profit against the starting base of $5,000. What allows us to do that is we are into a trade maybe on a Monday, out of a trade on a Wednesday, and recycle that capital right back into another trade. We have weeks where we lose money. We have other weeks where we make more money. Generally, the losses that we have in a particular week are a result of having rolled out, repositioned something in one particular week and gaining the benefit of that in a future week. The projected profits for the quarter on these accounts that I'm talking about right now, and we only have 2 weeks remaining in the quarter, but our projected profits for the quarter are $20,592 against that starting base of 5,000. Projected profits for 12 months are about 143,000. So this is why I say it's a powerful way to start small and grow big, but it's not complicated. We keep this just as simple as possible. And one of the best testimonials I can get from clients is when they send me an email, and I get frequent emails during the day telling me that they have learned so much from the daily recordings that we do, the daily education, and they feel confident with what they're doing. And that is exactly what we are trying to help people do. We want people to feel confident so they can become independent, self-motivated traders. Now, all these returns are, of course, subject to change in the future, based on our current run rate averages and plus resetting at the beginning of each quarter. Of course, you guys know there's no guarantee going forward, but that's what we are seeing right now. So here's what I would like to offer to you if this program looks interesting. A 6-month subscription to the Profit Builders program. We're going to send you alerts, email and text alerts each time we open, close, or manage adjust a trade. That way you can follow along with the trades that we are doing in our live trading room. We're going to specify for you the exact strikes, the expirations, and the number of contracts that we think you should trade based on a compounding of $5,000 for the quarter. We're going to provide to you a daily 15 to 30 minute in-depth analysis of each position. I do these 15 to 30 minute videos every day and send them out to you. I analyze the chart, I analyze the position, I describe to you the structure of the position, I describe to you why we're holding or why we're closing or why we opened a particular position. And the idea here is that in 15 to 30 minute snippets of learning, that's 15 to 30 minutes of education every day, your commitment to trading, you do that 5 days a week for 6 months, you are going to learn far more than you'll ever learn by trying to sit down and read a big book and then figure out where to get started. This is real-time trading in real time, and you're taking profits along the way. It's an opportunity for you to compound your account each quarter. So the offer that I'm making, Mark Chaikin has a great community, and I've found Mark to be an outstanding partner. I look around the world of trading education and charting education, and Mark is one of the, I think, premier contributors to that. So what I'm doing is I'm offering what is normally a $1,295 package. I'm offering it to you for $595. So it's less than $100 a month for the next 6 months. That price is good for the next 24 hours if that interests you. If you are interested, you can sign up directly at the following link. It is optionsmoneymaker.com/CPB. That's Charlie Paul Boy, CPB /. So that's optionsmoneymaker.com/CPB. If you have other questions that perhaps we don't get to today, feel free to email me directly, markd@optionsmoneymaker.com. So I'll leave that on the screen, and I am going to go to some questions, see what kind of questions you have. Now, as I said when I started, a lot of the questions that come up in the early parts of the presentation were answered frequently throughout the presentation. So I'm going to go through these and try to pick the ones that have obviously not been answered. Let's see here. Given times since high, do you use daily or weekly Bollingers? Al, we are evaluating daily Bollingers, 60-minute Bollingers, and 10-minute Bollingers. Those are the three preferred time periods that we use. So if I can open a new position and get outside all three of those Bollinger Band placements, I consider that to be a good placement for our strikes. Can you set a good to canceled order to close both sides at a projected 10% gain? Yes, absolutely. That's exactly what we do. We set a good to canceled order to close all four legs simultaneously for an overall profit. And typically, Al, we're setting our good to canceled order at 50% of the total combined credit between the calls and the puts. What is forgiveness? We talked about that already. Can you make these trades in an IRA? These trades, yes, can be made in an IRA, Don. Talk to your broker about that. If your broker tells you that they cannot be traded in an IRA, what they're really saying is they can't do it or they don't allow it in an IRA. But I trade at Options House. I've traded at Options House for a few years now, and I love their trading platform. It's the old Trade Monster. Trade Monster and Options House merged together here a few months ago. And absolutely, I mean, some of the accounts that we trade are IRAs, so there's no problem with that. Tom's asking a very good question, and it gets into perhaps semantics of how we look at positions, but why is the decision not just close the position instead of repositioning or roll out? And typically, Tom, it's because we still see it as a viable position. And if it's a viable position, then we want to go ahead and take advantage of it. And sometimes there's a short-term drawdown in that rollout, as opposed to just walking away with a loss and then trying to scratch our head and figure out what else we want to put on. So it's just our way, our proven way of working these successfully and recovering that drawdown. Rodney's asking, is there any particular time of day for the review? I suggest if you can work it into your schedule to do it about mid-market day. That's when I am doing the review that I am recording and sending out to everybody. But if you do it about mid-market, that's fine. But practically speaking, if you have a job or if you have a business to run and you do your evaluation once a day after the market closes, that's not ideal, but it still works because it will tell you what action you might need to take when the market opens the next day. Bob, yes, index options can be traded in an IRA account. You just have to make sure that you have the proper trading level authorization, so talk to your broker about that. Cobb is asking, why wouldn't you leg out of the short side of the credit spread and let the long run for a while? Well, Cobb, you're assuming that you know which direction it's going to move from here. And what you did was you just converted this from a very simple, very limited risk trade to a highly speculative, much more risky trade. You're going to let that long leg run for a while. You think it's going to run favorably for you, but if it runs unfavorably for you, you've got a lot of liability tied up with the cost basis of that long leg. That's an entirely different strategy. That's not simple, and that's not something that we would promote to people who are looking for a simple way to trade. George is saying your trades have ignored commissions. Correct. In the examples I'm giving you, yes. In the 12% average return per week, no. That is actually a net. The 12% average is net after fees and commissions, and that's the way we track it. Fees and commissions really aren't that expensive. It's just a cost of doing business in your trading business. And the types of returns and the compounding that you achieve, you're going to start forgetting about fees and commissions altogether. Cobb's asking, is the only reason you trade the index rather than the ETF, the American versus European style expiration? That's one of the main reasons, but it's not the only one, and I don't have time to cover, the extent of which we favor the indexes. But there's actually, in my opinion, no advantage to trading the ETFs over the indexes. You might as well just trade the indexes. Jim's asking, what do I mean by run rate? Run rate means we've established a series of profits or a series of trades, and if I take a look at the history of all those trades, it is averaging out to a run rate of 12%, meaning if I was able to continue to do what we've already done to date, then I would expect that I might be able to achieve a 12% run rate going forward, a 12% return going forward. I don't suggest any particular brokerage account. I do favor Option House. I think they've got an excellent platform. It's simple to trade. It's simple to set up these trades. We get excellent fills, and that's who I use. Is there any money back if profits are not seen for 4 weeks? I'm not quite sure how to answer that question. You're either going to see a profit sometime in 4 weeks, or you're going to be in a situation where you need to manage or adjust that trade. Okay, it's as simple as that. Something is going to happen in 4 weeks to that trade. What time frame do you trade? We typically push our expirations out 2 to 4 weeks when we're opening the position. Bob Patel is asking if we have a managed accounts program. Bob, you have to send me an email about that, something I can chat with you about offline. What's the advantage of using an Iron Condor or using a straddle? They're two different strategies. So what I was showing you is the simplicity of the Iron Condor. Does this system work even in periods of low volatility as we have been seeing currently? Absolutely. Bruce, this system has actually generated some huge profits for us just in the last month. And you saw what the quarterly profits are projecting for the quarter. So yes, it works extremely well. It's all about the placement of your strikes and the placement of your expirations so that you can take full advantage of this opportunity. Jack's asking, what percentage of an account do you place at risk on a trade? So the Profit Builder program, Jack, is talking about starting with $5,000 of risk. Now, I don't care if you have a $100,000 account, a $10,000 account. I don't care what the size of the account is. We're going to place $5,000 maximum risk when we start out. And then we're going to add to that risk as we accumulate profits through the quarter. So we want to say start with an account of greater than 5,000, and I would say a practical minimum would be 8,000, a practical minimum. 10,000 would be preferable. But we have accounts that have all different sizes, and we start with $5,000 of trading on each of those. Let's see. Brokers, answered that. The Bollinger Band time periods that we evaluate, again, are 10-minute, 60-minute, and daily charts. Will the trade alerts, will signals include number of trades based on our new $5,000 account? What we're going to do, Tim, is we're going to specify the number of contracts that we would suggest you trade to be in sync with our compounding, and that takes into account how much of our $5,000 account we're willing to allocate to this particular trade. Sydney's asking, what are the historical longer-term performance metrics? Sydney, they're very consistent with what we're seeing this quarter. But the Profit Builder program itself just started at the beginning of this quarter, and so that's why we're profiling that. But myself and my team have been trading credit spreads. The live trading room, we've been trading credit spreads like this for years. Now the live trading room hasn't been in place for years, but I've been trading these for years, and that's very consistent performance. The one aspect that is a little unique and why we're profiling it for this quarter is we've never focused on just starting with $5,000 and then compounding it. And the reason we did that was because we had a lot of traders coming to us wanting to learn, wanting simplicity, but they needed to start with a very practical amount of money. And so we designed this program to try to help as many traders as we can. Russ, you're going to have to talk to your broker about that. That sounds like a commission type question. So talk to the broker that you work with. Peter's asking, oh, great presentation. Thank you, Peter. I appreciate that. If we sign up, what is the ongoing cost for the service after the 6-month special? If you sign up for this discounted special of $5.95, then you're grandfathered at that price. If in 6 months you decide you want to continue being part of our community, which we hope you always will, you will be able to renew at the same $5.95. So you're actually getting a full year for less than the regular price of $12.95. All right, I'm just getting to the end of questions here. If you sign up today, when do you start trading to sync with your trades? You can start immediately. We're aware of people coming and going in the Profit Builder program. I shouldn't say going, they're all coming, actually. And we're very close to starting over for a new quarter. But we're starting to size the positions for a large number of new people who are coming in also. So if you sign up today, your alerts will actually start tomorrow. And that, Bill is asking a question that comes up frequently, and it's a good question to present. We're having lots of us doing this skew and option numbers price. Not at all. The NDX, SPX, and RUT are 3 of the most largest widely traded indexes in the world. So we just don't have enough capacity to influence them that much. Rabinda, yes, you could start with $6,000, and you could actually take our trade alerts. What I would recommend is you take our trade alerts and you decrease the number of contracts by like 1 contract on each trade alert, so that you still have a comfortable margin for being able to manage and adjust if necessary. If you join the program and then you decide it's not really right for you, we do have a prorated refund policy. So if you decide to leave after 2 of the 6 months, then we refund the difference of the 6-month subscription to you. We'd like to think that you're committed to learning, and there will be some things in the beginning that you need to just be patient with and learn. But if you stick with it for 6 months, I think you're going to be pretty happy with the amount of money that you learn. Do you trade and teach other methods or systems, or do you only trade credit spreads? Randy, we trade calendar spreads, diagonal spreads. There's a double calendar spread strategy that we teach and trade called a market tamer. We trade something called combos. We trade more extensive charting. This Profit Builder program is really designed for people who are looking for simplicity or a way to get started. We have numerous people who then decide to pursue some of our other teachings and even then inquire about joining our live trading room. So we do quite an extensive amount of trading on other strategies also, but they're not strategies that we use with the Profit Builder program. All right, I think we are past our time here. I apologize, I've actually kept you over quite a bit, but quite a few great questions here. If you have other questions that we didn't get to today, please send me an email, markd@optionsmoneymaker.com, and I will do my best to get back to you as quickly as possible. There is no code down for the discount as long as you use the URL that is on the screen in front of you that is geared for that discount. It is optionsmoneymaker.com/CPB, and that is set for the $5.95 price. All right, thank you so much, everyone. I really appreciate you all being here, appreciate you choosing to spend a little bit of your time with us today. And I want to thank Mark Chaikin and the Chaikin community for the excellent work they do for traders. I know Mark is like me. He's very committed to helping traders learn how to trade, learn how to make money. It's not just about us selling education. It really is about us taking pride in having traders who are making money and enjoying what they're doing. So with that, I'm going to end the webinar and say, again, thank you very much. Send me an email if you have a question, markd@optionsmoneymaker.com, or if you like what you see, sign up directly at optionsmoneymaker.com/CPB. Thank you so much, everybody. We will be sending a copy of this recording out tomorrow.